Hello, and welcome to our understanding of the Spring Budget 2023 and what those changes mean for your pension webinar. I'm Bronwen Horton. I'm one of the financial planners here at Killick & Co. In our wealth planning team. And I'm joined today by two of our partners, Shaun Robson, Head of Wealth Planning, and Will Stevens, Head of Financial Planning. So the aim today is to provide you with an update of the recent changes, and we'll be using a few case studies to bring this to life. Here we'll also be focusing on providing you with information only. We won't be able to give you any specific advice or recommendations. So following this, if you'd like to speak with one of our planners to answer more details or to review your current situation, there'll be an opportunity at the end to follow up with us. We've allocated about 20 minutes to cover the update and case studies, and then we'll follow up with a question and answer section. A number of you have already emailed us in specific areas that you'd like us to cover, so these will be incorporated. However, as we go throughout today, if you have any questions or need something clarified, please use the Q&A function in Zoom. So after the Q&A session, I'll explain about where you can go for further information and how to obtain the recording and slides from today. Without further ado, let's get started. So what I'd like to do is hand it over to Shaun, if I could start with you. If you wouldn't mind outlining the current changes and timeframes as to what's happened to date.
Lovely, thank you, Bronwen, and good evening, everybody. So we have the Chancellor to thank for the changes to the lifetime allowance that were announced in the spring budget on the 15th of March. Now, clearly things have dramatically shifted for pension savers. We were at the time expecting the lifetime allowance to increase to 1.8 million, but I think the announcement to remove the lifetime allowance entirely was rather a seismic shock to both the pensions industry, advisors, and savers alike. Now, we shared our initial thoughts on the announcements quite quickly in the days that followed the budget, but we've now had sort of 6 weeks to digest those announcements and a little bit more detail that we've had from guidance notes issued from HMRC for what we expect to be included in the upcoming finance bill. And I think the key point to note is that the majority of these changes are based on a finance bill, a fiscal event that the government are planning, which effectively needs to go through a number of readings in Parliament, passing both houses, with an expectation that that's completed before the summer recess. So hopefully by sort of 20th of July, when that summer recess takes place, we should have a bit more clarity within the next 3 months on what this actually means and what these rules actually look like from a legislation point of view. And in the future, we'll have to wait and see what happens really with the lifetime allowance beyond sort of this tax year. So in today's session, we really want to explore, where we are today, where we're potentially going, and what you can do now in terms of taking action. What little we have at this point is really the small detail that was published in the budget statement, and the measures brought in and what it is in the finance bill is just making sure that nobody faces an LTA tax charge this year, which is sort of the first point we've made here on the slides. Now, the government will, at a future fiscal event, make the necessary changes to entirely remove the lifetime allowance from tax legislation, with the aim that that will take place from the 6th of April 2024. And technically, pension providers will still need to complete lifetime allowance calculations this year. So it really remains business as usual in that sense, that the lifetime allowance calculations will still take place. It's just that if you are subject to a lifetime allowance tax charge in the current tax year, that will be charged at 0 rather than the old lifetime allowance tax charge rates. Now, we've been asked a number of questions about lifetime allowance tests and charges that perhaps took place in the last tax year, and if these will change now. And unfortunately, anything that happened in the last tax year follows last year's rules, and nothing will change retrospectively in that regard. For this year, if taking benefits and an excess exists, as I've mentioned already, the charge will be zeroed out. And next tax year, we expect the finance bill to remove the lifetime allowance entirely from legislation, something that's actually been in place for the last 17 years. So the notion of the lifetime allowance was actually introduced back in 2006. So not only is the lifetime allowance impacted in a big way. Pension commencement lump sums, so something that's more commonly known as tax-free cash to most of us, will also be impacted. Now, since the lifetime allowance was introduced back in 2006, tax-free cash has been limited to 25% of the standard lifetime allowance. Currently, that's set at £268,275. As the lifetime allowance has decreased from its high of 1.8 million back in 2012, there have been a number of opportunities for pension savers to lock in to that lifetime allowance and tax-free cash with various protections along the way. Now, these protections still remain valid and still remain relevant for those that hold them, and will allow those with those protections to benefit from potentially a higher level of tax-free cash than what we have currently, the standard level of tax-free cash. So the rules remain the same for this year in getting access to your pension commensurate lump sum. It's capped at the lower of 25% of your fund value or 25% of your remaining lifetime allowance. Going forward to the next tax year, we don't know for sure, but suspect if you have been, if you've taken your full pension commensurate lump sum in the past, you're unlikely to get access to any more pension commensurate lump sums in the future. But of course, we need legislation to confirm exactly what those changes look like from 2024 onwards.
Excellent. Shaun, thank you for covering the lifetime allowance and all of the protections which are in place. Will, maybe you could update us on the changes for those who are still contributing to their pensions and how these have changed.
Yeah, absolutely. So the Chancellor not only changed the lifetime allowance or removed it altogether, but he also changed most of the contribution allowances to pensions at the same time. A little simpler to get a head around because they all came into effect from the 6th of April 2023 rather than being staggered over multiple years. But the biggest one here is the core change of the annual allowance from £40,000 up to £60,000, so 50% increase on where it stood previously. At the same time, they've also raised the tapered annual allowance and the money purchase annual allowance contribution limits. And they've also adjusted the point at which you would become into force with the tapered annual allowance. So for those who aren't familiar, the tapered annual allowance reduces the amount of pension savings one can make once you start to earn over a certain level. And the rate of withdrawal is £1 for every £2 over the threshold that you earn. So we've got a nice diagram here to sort of illustrate this, but as you pass the £260,000 limit as it stands now, and that is threshold earnings, so that is income from all sources, taxable income from all sources. As you pass that stage, your allowance for what you can contribute to a pension in any 1 year will reduce. So for the average, for most people, it will be £60,000 their annual allowance. But once you pass that, as you can see, it tapers down so that £280,000 of earnings, it's at £50,000, all the way up to £360,000, where it'll be a £10,000 annual allowance for those high earners. This is quite a significant improvement on the previous position. Not only has the annual allowance itself increased, the tapering level has also risen by £20,000. It was at 240 previously. And then the lowest threshold for how much you can contribute has over doubled from the £4,000 to £10,000. So this is good news for very high earners, individuals with incomes in excess of sort of £300,000 who previously would have been very restricted in what they could put in. But it's also good news for those who have already potentially accessed some pension savings and are looking to continue to save moving forward into the future. This is often a downplayed segment of the market, but it is those individuals who can afford to save in later life and want to put money back into those valuable tax wrappers. So the money purchase annual allowance, for those who aren't familiar with that either, comes into effect for anyone who has drawn pension benefits flexibly. And now what does that mean? That means you need to have taken an income rather than the pension commencement lump sum or tax-free cash that Shaun was talking about, but rather an income, a taxable income from your pension by form of flexi access drawdown. which for those who aren't familiar, that was what came into effect in about 2015 and is the way in which most pensions operate today. So if you have taken income from a pension, you are limited on what you can put back into the pension. Historically, the threshold was at £4,000, but it has gone up to £10,000 as well. So for those who have accessed their pension but are still looking to save, it creates another opportunity there at the same time.
Brilliant. Thank you, Will. And probably just following on from that, we've had a number of clients ask us that they've stopped contributing to their pensions and whether now they should start again. Do you want to just sort of cover that a little bit more?
Yeah, absolutely. So it's always going to be circumstance dependent as to whether you should start contributing to your pension again. So there's not going to be any advice that we can give today that's going to cover everyone's circumstances. But for those who can afford to continue contributing to their pensions and have previously stopped, say they stopped a number of years ago for fear of breaching the lifetime allowance and perhaps having to pay a tax charge on that savings where they could otherwise do something else with the money, perhaps that was employer contributions that switched to income in lieu of pension payments, or even those who decided to prioritize saving into other tax efficient vehicles, perhaps ISAs, perhaps VCTs, or even EISs. It gives an opportunity for them to reconsider pension contributions. The removal of the lifetime allowance does create no upper threshold for your level of pension savings, and the changes in what you can contribute also give a rationale to put more away and claim that valuable tax relief that is available, particularly if you have earned income to offset against it.
Brilliant. Fantastic. And Shaun, maybe you could talk us through what are some of the future risks, change of government, but also acting now ahead of the finance bill being enacted.
Yeah, thank you, Bronwen. And I think first of all, as we've already mentioned, that we are waiting really for the real nuts and bolts of the detail to come through in the finance bill. I think the pension industry already has been canvassing government and HMRC for some guidance around and raised a number of questions about how they can administer these changes and, for instance, monitor taking of tax-free cash in an environment where there are no longer lifetime allowance tests. I think when you look at the way that pensions legislation is entwined in various tax acts, I think just looking at the Finance Act 2004, there's around 600 pages of pension legislation that will need to be repealed. It's a big task for the government and HMRC to abolish the lifetime allowance. So there's a real risk that the time it takes them to do so, there might not be enough time between now and a finance bill in the summer to be able to do so. And equally, there's potentially the risk that they see how this zero tax charge goes and potentially decide that they don't necessarily need to go down the road of entirely abolishing the lifetime allowance. So that's the key thing for us in terms of the next stage. It's getting to that next stage before taking certain actions ahead of that being in legislation. And then if you look beyond into kind of the future tax years, I think clearly the biggest risk is probably a change of government to a Labour government. I think the day following the budget, the Labour announced that they would look to reverse the changes that were announced by the Conservative government. Now, Labour made it clear their preference is for an NHS-specific solution to solve the issue of trying to keep professionals like doctors and nurses in the NHS for longer. This was the pretense, really, for the changes to the lifetime allowance. And now it's unlikely that if the LTA is entirely abolished, it's unlikely we will see a full reversal by a Labour government in the future. It's probably more likely that they would bring back an LTA regime of some sort, and that could be at a varied level. It could be NHS specific, but who knows? By the time they come back into power, that could be next year, but that could also be 6 years plus, and they could have other political priorities at that point in time. So there are, I guess, so many unknowns. As I said, a reversal is unlikely, but could be a reintroduction of the LTA regime. And I think what this does do is present a window of opportunity between now and the first post-budget, the first budget of a post-Labour government. What's clear is that if the LTA is removed from legislation, it would be incredibly complex to put it back in, and there would be again this window of opportunity to take action. And I think really, the purpose of being here today really as well is to raise those potential actions that pension savers could consider in the intervening time. So very high level, consider paying a pension contribution in, even where you have protection in place. Decide to fund your pension beyond the lifetime allowance, even if it's not necessarily for your benefit, but for your beneficiaries. And for those already beyond the lifetime allowance limit, consider taking the excess above your lifetime allowance as either a lump sum or designating it to drawdown, whilst we have this tax charge, this lifetime allowance excess tax charge at zero. We don't know how long this window of opportunity will be in play for, particularly if there's a change of government to Labour in the future.
Yep, wonderful, Shaun. And maybe, Will, you could discuss with us sort of what you think, whether there'll be any sort of more future changes, or where do you sort of see it going at this stage?
Yeah, thank you. I think, the one thing that's always certain with pension legislation is that there will be future changes. If we cast our minds back all the way to A Day in 2006, that was supposed to be a great change in pensions legislation. And after that, everything was supposed to be plain sailing. But we've probably seen an increase in the pace of legislative changes on pensions over the last 15 to 17 years. 2015, we had pensions freedoms, we've had various levels of lifetime allowance, contribution level changes. And I think it's certain that we will get more in the future as well, and potentially at a slightly faster pace than we have seen. Obviously, a key thing to watch is the political manifestos that come out ahead of a general election next year, and we're certain that there will be more change regardless of the winner of the next election, because there will be parties who want to move forward their agenda. I think the one thing to add to what Shaun was saying in terms of the uncertainty, or maybe 2 points to add to that in terms of the uncertainty, is one side to say that in most cases, changes on pension legislation do take some time to be implemented. And that is due to the fact that the pensions industry as a whole needs to implement those changes. So if you were to remove the lifetime allowance altogether, to reinstate a lifetime allowance, you would have to allow the pensions industry time to develop systems to calculate it, to monitor it, to create the charges that are needed. Going beyond that, I think it really does sort of bring to the surface the point of constantly being aware of what is going on in the pensions industry. They make it very difficult for retail investors to keep up to date with what they need to be doing from a pensions perspective. And that's one of the main reasons we're here today, is to try and help people understand these changes, what they should be thinking about. And then, if there are individuals who want to have broader conversations, that's where we've got the opportunity at the end for them to reach out to us.
Wonderful, thank you, Will. What we'd like to do now is to bring all of this to life, and we've got 7 case studies of a number of different scenarios, which we'd just like to run through, because it might sort of help a number of you in your current situation. So maybe, Will, if I could start with you in case study number 1, and we can work our way through there.
Yeah, perfect. We'll keep these fairly brief, but they're relatively straightforward, and believe that the intention is to circulate these slides following the webinar for anyone who's been tuning in, or anyone who watches from home at a later date. But going back to what I was talking about, contributions earlier, in this case study, we've got James, who's a very high earner with an income of £300,000 a year. Under the previous rules, James would have been capped at contributing £10,000 to his pension in the tax year. However, following the increase to the annual allowance and the increase to the threshold for the tapering, under the new rules, James can actually contribute £40,000 to his pension, which would have been the entire annual allowance in the previous year had he not even been tapered. In fact, to get down to that £10,000 point now, he would need to have an income as high as £360,000 or higher to reach that level.
Okay, so case study 2, we're looking at a Mr. and Mrs. Sugar, who are a family business owners. and are looking at the profits within their business that currently sits at £400,000, and looking at ways of potentially extracting profit out of their business tax efficiently. So they're considering whether they can use pension contributions as a way to move money out of the business and start building pension funds tax efficiently. So they have looked back at their previous history of pension contributions. In the current tax year, they're able to contribute £60,000 each, and then looking back through their prior contribution history, they're able to catch up all of their unused allowance from the last 3 tax years, which would be an additional £120,000 each, so £40,000 a year for each of the last 3 tax years, meaning they can each contribute £180,000 from their company into their pensions, meaning they can move £360,000 this tax year out of the company into their pensions, and therefore reducing their corporation tax bill and profits for their corporation tax bill from £400,000 down to £40,000. Just a really good example of how it can be very efficient to use pension contributions, as they're now starting to increase as well, the ability to do so, to become much more attractive for business owners to look at pension contributions going forward.
Move on to case study 3. Helen, age 50, who has a current pension value of £800,000. And has been taking additional income in lieu of pension contributions. This is going back to my comment earlier about the alternatives that have been offered to individuals historically. Under the old scheme, and I won't dwell on the maths on this too much in case someone points out that I've made a mistake in it, but under the previous rules where she was taking the income in lieu of pension contributions, there would have been national insurance to pay on that, income tax to pay on that. And so after all was said and told, the actual amount received would have only been £10,000 and £10,070 in extra take-home pay, having netted off for what Helen would have otherwise made as a personal contribution and what the business would have otherwise made as an employer contribution. Under the new rules, Helen's no longer worried about an LTA tax charge and wants to maximise the level of her pension benefits. As a result, she's going to restart pension contributions both personally and on the employer side. And so those levels of £10,000 a piece start to come into play, meaning that Helen is now receiving £20,000 a year additionally into her pension, which is being invested. That invested capital will hopefully grow and compound over time. But even if she were to draw that out immediately, of that £20,000, 25%, so £5,000 would be the PCLS, the tax-free cash element, and then the residual amount would be taxable as income. So a quick calculation of £15,000 at 45% gives you roughly £8.25. Total income, therefore, £13,250, which is a significant improvement from the position previously where Helen was paying national insurance contributions and income tax on the full value.
Okay, looking at case study 4, John, who is at retirement but still working, has exceeded the lifetime allowance of a pension pot currently valued at £1.5 million, and he locked in with fixed protection 2016, which gave him a personal lifetime allowance of 1.25 million. Now, under the old rules, his pension savings, which are currently £250,000 above the lifetime allowance, if he fully crystallised his pension, he would be subject to a tax charge of a minimum of £62,500, so 25% on the excess. Or if he took that excess as a lump sum, he'd pay 55% tax charge, which would have meant a tax bill of £137,500. Although John is working and can afford to make contributions, if he did, he would have forfeited his fixed protection 2016, and by doing so, he would then revert back to the standard lifetime allowance of £1,073,100. Therefore, crystallising his full pension pot, £1.5 million, he would have increased his LTA tax charge by an additional £44,225. And even worse, in that situation, his maximum tax-free lump sum would have reverted back to 25% of the standard lifetime allowance rather than 25% of his fixed protection. Under the new rules, John is no longer subject to any LTA tax charge. He can also make pension contributions again, and this will not reduce his tax-free lump sum, which remains at 25% of the 1.25 million. That's locked in. He also is able to make additional contributions, but they will not provide any extra tax-free cash. However, he is happy to contribute as he is a high rate taxpayer, expects to be a basic rate taxpayer in retirement, and this means that he can receive 40% income tax relief now on those contributions and expect to be a 20% taxpayer when he takes money out in retirement. So therefore, there's a nice tax saving for him in terms of considering continuing to contribute. And, you know, in this situation, looking at the sort of inheritance tax position, it's a concern for John in terms of passing on assets to the next generation. He likes the idea of continuing to put money into his pension, knowing that it sits outside of the estate from an IHT point of view, continuing to grow the pot, even if he isn't going to draw down on it himself in retirement.
So on to case study number 5, Richard, who has retired. Richard has an uncrystallised pension valued at £3 million and no lifetime allowance protection. Under the old rules, the entirety of the excess of Richard's pension would have been subject to the lifetime allowance, and his tax-free cash would have been limited to £268,275. As you'll see from the numbers here, the LTA tax charge, if taking just the 25%, would have been as much as £481,000. However, under the new rules, given the scrapping of the lifetime allowance, the lump sum remains the same in this instance, as Richard didn't have any form of pension protection in place, but the LTA charge that he previously would have paid has been zeroed out. So this is with immediate effect for someone like Richard, who's not worried about the finance bill later in the year. You know, this is a net benefit this year with a 0% charge. So Richard's got a potential saving of almost £500,000 on his pension benefits. Just a reminder for individuals, the lifetime allowance tax charge is taken directly from the pension itself, and is usually done by the scheme administrators. It's not a tax charge that appears on a tax return or is payable directly. Quickly talk through case study 6, which is a very similar situation to Richard in case study 5, but in this circumstance, Susan had fixed protection 2016, which gave her a protected lifetime allowance of 1.25 million, and therefore a protected tax-free lump sum of 312,500. Again, we've got those sort of numbers on here for everyone to look at in terms of the potential tax charges, but you're looking at 437,500 if it's taken as income, potentially as much as 962,500 if it is taken as a lump sum. Under the new scheme, Susan is able to benefit from that protected lump tax-free cash pension commencement lump sum that she had of £312,500. So that remains the same, but she's also able to benefit from a disappearance of the LTA tax charge. So again, it's been zeroed out, so that potentially £400,000 to £900,000 of pension savings that would have otherwise been forfeited in tax charge, she's able to retain for herself, as Shaun has mentioned, for her beneficiaries in the future.
Okay, so the final case study actually really reflects back on the point I made in the sort of opening slide, which is any LTA events that took place in the last tax year, they won't be revisited. There is no retrospective action that can be taken. That happened under the old rules, and that will continue to be the case. So this case study looks at Paul and Michael, who are two old school friends. Paul was 75 on the 6th of April, whereas Michael was older by one day, and he turned 75 on the 5th of April, so at the end of the last tax year. They've both been successful in building up substantial pension funds. They have used up all their lifetime allowance, and the pension funds both had an excess of £200,000. Michael's fund was tested first, and because he had no unused allowance remaining, he suffered a tax charge of £50,000, which is equivalent of 25% tax charge on £200,000 excess that he had within his pension. And then he was surprised to learn that Paul doesn't have a tax charge to pay at all, because whilst there is still a test for Paul on the 6th of April, there is no tax charge because it's been zeroed out under the new regime. So the only difference there is that one day between Paul and Michael's birthdays, and there's nothing that Michael could do about that. Unfortunately, the spring budget changes are not retrospective, and there will be, I think many pension savers who have paid significant LTA tax charges purely because of when they were born and the arbitrary nature of the way these rules have been brought in to take effect from the 6th of April 2023.
Wonderful. Well, thank you both for taking us through those case studies and bringing the changes to life. What we'd now like to do is open it up for questions. So if you wouldn't mind putting these in the Q&A function in Zoom. If we do run out of time, what we'll do is at the end of the session, we will make sure that you can speak with one of our planners and they'll follow up on the questions. So please do keep putting them into the Q&A section, and we'll try and get through as many as we can. A lot of these are double up, so we'll try and make sure that we cover as many of these different areas for all of you as well. So I'd just like to start with one question here. Having taken my maximum tax-free cash and regular income from my SIP, is there any post-budget action which I should be taking? Maybe Will, maybe you could cover that for us. Oh,
You're on silent, Will.
yeah, you're on mute.
Absolutely. Thank you, Bronwen. I'll jump in on that one because it links back to what I was talking about earlier. So thank you for the question, whoever submitted that. What we're covering here is 2 points. You've taken your maximum tax-free cash, but you've also taken some income. That income, that regular income payment, will have triggered the money purchase annual allowance. So the money purchase annual allowance will now limit how much you can put in to your pension, should you wish to, on an annual basis, which would have brought it down to £10,000. And that's the amount that you could contribute to a pension and receive tax relief on that contribution. So that's the gross amount. For those who are over the age of 75, you would have passed the point at which you can make tax relievable contributions to a pension. But assuming you're under that age and you have a level of earned income from outside of your pensions, and that's an important point because we don't want to get into the realm of what is known as pension recycling, which is taking money out of a pension to put it back into a different pension. If you have earned income from other sources and you are able to make those contributions, there may well be merit in doing so now.
Excellent. And Will, somebody else has just asked, and I know that Shaun covered this, but it's talking about the restrictions there. So in case study 3, if she did take the pension lump sum, wouldn't she be restricted by the 10,000 contribution now? Do you want to just clarify that as well?
Yeah, I'll just clarify that. So the answer to that is no. So the difference is between the pension commencement lump sum and income. If you just draw the pension commencement lump sum, you don't trigger the money purchase annual allowance. It's only when you draw a taxable income from your pension that you will trigger the allowance.
Excellent, thank you. Shaun, potentially one for you. So this person has had LTA protection at 1.5 with restrictions on additional pension contributions. Can I now use some of my pension income to reinvest in my SIP and receive income tax relief? So potentially what Will was just saying there about the pension recycling. Could you just sort of clarify that a little bit?
Yeah, of course. Good question. So for those that have sort of fixed protection, I think we're talking about there's probably fixed protection 2014, which was locked in at 1.5 million. And if you've taken your tax-free cash already and you're starting to draw an income from your pension, Will alluded to it there, you are going to be restricted by what we call a money purchase annual allowance. Now that money purchase annual allowance historically sat at a figure of £4,000 a year. And as Will mentioned, to be able to make pension contributions at that level, you need to have the net relevant earnings to do so. The challenge that you also have in that situation is if you've just taken the tax-free cash, Will alluded to this again, it's the pension recycling rules. Now, they can be quite complex. There's a calculation that's done in relation to how much you can contribute into a pension in relation to the amount of tax-free cash you've taken. So it's something that would need to be investigated in a bit more detail to be able to answer that specific question around how much could you potentially contribute. There's a few limiting factors there that would impact, but principally the answer is yes, you can contribute again, but actually you need some advice to make sure that the level of contribution doesn't fall foul of all of those different rules.
Excellent. Another question, and I'll send this your way. Again, somebody with protection of 1.5 million, but slightly different. I've drawn down all my pensions, taking the 25% cash, but not taken any other payments except for one small defined benefit scheme. I believe that the new rules allow me to still put in 60,000 a year again, and in fact thought that I've used up 96% of my protection will not make any difference. Can you just explain a little bit more about that?
Yeah, so in this instance, the individual who's asking the question is one of those individuals whose pension protection, the fixed protection that they had in place that protected their lifetime allowance, the main benefit to them is the tax-free cash, the PCLS. So assuming that has been taken, then they're now, the main focus for them now is under the new rules effectively, and what position does it leave them in moving forward. That position is one where there is potentially no further lifetime allowance tax charge to pay. It's 0 rated for this year, and it will likely not exist next year. And so that individual could now start making contributions into their pension and bolster those pension pots up. There'd be a variety of reasons for doing so, but if you've got the relevant earnings, one of those might be in order to receive the tax relief on the pension contributions, and another would be, as Shaun has mentioned a couple of times, the potential inheritance tax implications of pensions, which make them excellent long-term intergenerational vehicles for transferring wealth. Pensions sitting outside of the estate for the purpose of inheritance tax.
Yeah.
Just one thing more to add, Bronwen, on that point as well, which is they will have already used their lifetime allowance. So they will no longer get, from what we understand, the way these rules will play through in the finance bill, they won't get another bite of the cherry when it comes to a pension commencement lump sum. It's that they've already had that money out of their pension via their fixed protection. So therefore, any contributions that they make going forward, yes, they will get tax relief on their way in, and it'll be beneficial from an IHT perspective in terms of building the pension pot up, and hopefully there'll be no more LTA tests in the future, subject to perhaps a change of government. Key thing for them to note is they won't build up any more pension commencement lump sum, so they won't accrue any more tax-free cash. So when they do come to draw money out of the pension, whether it's themselves, they will pay income tax, or equally their beneficiaries when the asset, the pension passes on their death. Yeah.
And also too, I think noting there that even though they've taken the small defined benefit scheme, that actually doesn't impact it at all as well.
Yeah.
Okay. And now, Shaun, probably another one for you is because you mentioned about inheritance tax planning. So a very broad sort of question: are pensions a good inheritance tax planning investment for somebody who's over age 75?
Yeah, great question. And I think it was since George Osborne stood up and made those pension changes and pension freedoms came about in 2015, 2016. We spend a lot of time talking to clients about pensions really being what we call sort of the asset of last resort when it comes to building your own income in retirement and thinking about how you pass your family wealth through the generations. The pension has become almost the go-to vehicle for building your wealth and thinking about how you pass that on once you pass away. Now, these changes haven't made any changes to that notion. They continue to be a very tax effective way of passing money through the generations on death, and continue to be that way for those that are over age 75. I would caveat that now there looks like the LTA will be removed, so therefore there is no ceiling on how large a pension can grow. The rules around sort of them sitting outside of the estate from an IHT point of view look even more generous than they ever have done historically. So there is that risk with perhaps a future change in government and a Labour government that's one thing that gets looked at in the future. But as it stands, we can only advise based on kind of where we are and what we know and the rules that are in place. They continue to be a really effective way to grow your wealth and pass that to the next generation.
Wonderful. And now another question here. Could you clarify that the LTA charge is 0 from the 6th of April 2023?
Yeah, absolutely. As I covered in the sort of the slides at the very beginning, that's the biggest change that comes into effect immediately. As I mentioned, the LTA test still exists. So if you're an individual that is perhaps looking at taking pension benefits this year, or you're turning 75 this year, you will have to go through the process of passing the information to your pension provider of any other pensions you perhaps have drawn in the past. And if you are subject to an excess, that test will still take place. The excess will still be reported, but the charge will be at a 0 rate rather than the old rates that were applying last tax year.
Perfect. And now somebody else, so their mother had a charge of 25% in February of this year. There is nothing that obviously we can do about this. Is it the same as the last example that you explained? Any thoughts? So charge has already happened in the last tax year.
Yeah, as I think I mentioned, as I mentioned at the very beginning, anything that did take place in the last tax year, it happened under the old regime, and there's nothing that can be done. It's one of those things from a time perspective that you're not necessarily in control of. That's now happened, and there will be no change or reversal of those previous lifetime allowance events.
Perfect. Will, another one for you on the tapering of high salaries. So is the 10,000 amount an additional to the 60,000 allowance, or is it the higher you earn, the less you can contribute? Could you just maybe clarify that for us? Yeah,
absolutely. So it's the latter, unfortunately. The more you earn, the less you can contribute. So it in effect, as your income rises, the amount that you can contribute to your pension comes down. So it's as you pass that threshold, the contribute your personal allowance, your personal annual allowance begins to come down by £1 for every £2 over it you earn. So you can think of the tapered annual allowance as a form of personal annual allowance that replaces your own one.
Mm-hmm. Perfect. Now we've potentially covered this one a couple of times, but I think it's well worth just reiterating it. So Will, for you, we've got somebody who's got fixed protection 2016, so stopped contributing to the DC workplace scheme, as expected to breach the lifetime allowance had they continued. The company is paying them a contribution, so their contributions and their pay. What factors should they consider when considering starting to restart those contributions to their pension?
Yeah, so the first thing I would consider is potentially waiting until the finance bill has been approved by Parliament, because the elements around removing the lifetime allowance altogether are the elements that protect the pension protection historically as well. So if you have a protected lifetime allowance in place and you made a contribution now, and for any reason the finance bill wasn't passed, it may well be that you could end up losing your pension protection. Now, that is a very big if. I think we can, if we look at things from a logical standpoint, you're talking about a majority government not passing its own budget through Parliament, which is unlikely, not impossible, but unlikely, and things have interfered in those historically. Famously, there was a change around state pension age, which due to the changes around Brexit and the referendum, actually ended up taking several years. I think it was about 3 years for the finance bill to get signed off. We're not expecting that sort of delay this time. We are expecting for it to pass with relative ease. That's certainly worth considering. Then at that stage, it's about what level of contributions do you make. and that will vary on an individual basis. It may well be that you have a match scheme available through work, in which case there could be benefits to taking that match, or maybe it's a flat rate from your employer, in which case you could take that. And then I guess an even more specific question for the individual is, what is the money going to be used for at the end of the day, and how much do you need to put in your pension versus other vehicles? There's always, could you save up in alternative sources? So there are a lot to think about, but I'd start by just holding off until the finance bill had passed, and then I would probably look at the options available through the scheme and potentially seek advice at that stage.
Brilliant. And I guess following on from that and the finance bill being passed, how narrow do you think the window of opportunity between the finance bill being passed and the next election is for somebody?
I'm happy to take that. I think the point I was making earlier about the time it takes for the pension industry to implement changes is a factor here as well. But if we say that the election is due to take place in 2024, it's currently pegged to be in the second half of the year, that would potentially put a government in place prior to Christmas of 2024. Assuming it's close to Christmas, they may leave it to do a spring budget in the spring, but assuming it's a bit before that, they could hold an extraordinary budget or even an autumn statements change legislation, but those changes would likely be with effect from the following tax year. It's very difficult to implement changes mid-tax year without causing quite a lot of administrative burden for the industry, which is then difficult to report on. So I suspect the gap is this tax year and next tax year, but then it's very dependent on what happens politically in that period of time as well. And if the objective, the pretense for this all being keeping doctors and senior civil servants and others in industry for longer works, then there may be pressure not to make any changes at all.
Brilliant. Thanks, Will. Maybe looking at death benefits. One question, maybe Shaun, for you to answer. If I died after age 75, my pension would get passed down to my beneficiaries, and would they pay income tax when they draw it down? You want to just clarify sort of when we look at death benefits?
Yeah, very good question. So looking at death benefits having passed away after age 75, what happens at age 75 is if you have any pension benefits that haven't been drawn, so haven't been crystallised or taken, there would be a lifetime allowance test at age 75 to test them. So then we move beyond age 75. When you pass away, there are no more lifetime allowance tests to take place. However, the pension would sit outside of the estate from an IHT point of view, but when your beneficiaries come to draw from the pension pot, they would pay income tax at their own marginal rate as and when they draw from the pension, the same way that you would do now post age 75. If you were to draw from your income, draw from your pension, you pay income tax yourself at your own marginal rate of income tax.
Perfect. Well, maybe could you help with the definition of adjusted net income, and has that changed at all, or has that stayed the same?
I can help. This is quite a technical question, so thank you for that. There's been no change to the way in which it is calculated, but there has been a change to its threshold. So the adjusted income element is what comes into the calculation for working out whether you've passed the taper. So that taper previously was at £240,000 of adjusted income and has moved to £260,000 of adjusted income. In terms of the definition for it, the adjusted income takes into account all elements of earnings. So this is looking at, what do you receive in terms of income from all sources, but it also makes an adjustment for pension contributions being made to you by your employer rather than your own personal ones. And so it's effectively in fairness, your total remuneration, including pension benefits, plus any other income from any other sources. So if you are an individual who potentially owns buy to let, for example, the rental income from that could also be included in the calculation. And so it's definitely a technical point. And if you are trying to work it out, I would suggest speaking to a specialist in the form of either a financial advisor, wealth planner, or an accountant.
Excellent, thank you. We've had lots of questions about fixed protection, but I do think we've probably covered a lot of these. I think looking at the time, it's potentially about time to start wrapping up and maybe going through sort of next steps. So thank you everyone for joining, and we hope you found it useful. What we're going to do is pop up a question for all of you to answer, because there was quite a lot of you asking sort of, you know, quite detailed questions. If you could just answer that question as to whether you would like somebody, a wealth planner, to get in touch with you. If there are any unanswered questions which we haven't covered today, we will ensure that we follow those up. So here at Killick, we really do value financial education. So following on from this webinar, there are a number of places for you to go for sources of information. Firstly, from our website, you can go and download, there's a number of useful how-to guides, such as how to fund life after work or how to generate post-work income. So please, if you do want those, you can sort of download those from the website. Secondly, if you want to have, sorry, there will be a follow-up email coming through tomorrow, and that will have a survey on it. So please do give us your feedback, as we'd love to hear that from you. As we mentioned earlier, a recording of this and the slides will be shared with you as well for you to review. And again, any questions, please do let us know. Like I said earlier, any unanswered questions we will follow up in the next week or so. And any questions that we haven't answered, you know, if you want to send them in, please do. And finally, both our Northcote Road and Esher branches will be hosting an in-person event on June the 14th, covering a number of these points which we've covered today. So if you'd like to go in depth again, please do come along, or if you know anyone else who may benefit from this information, please do email us at events@killick.com. But for me, thank you very much for joining, and we'll look forward to seeing you all soon. Thank you.
Thank you, Bronwen. Thank you, everyone.